Welcome to the Bekaert Tax Beat, a conversation about tax that matters.
Good afternoon. Welcome to this edition of the Bekaert Tax Beat podcast. Today is July 27th, 2021. Today's topics are the international tax issues surrounding the current tax proposals from the Biden administration, as well as what's going on in the global network. So let's first introduce the colleagues joining me on today's call. Sarah.
Hi, this is Sarah McGregor. I'm calling in from Greenville, South Carolina.
Brian.
Yes, I'm Brian Dill, international tax partner based in Atlanta.
And Mike.
Hi, I'm Mike Cornett. I'm a director in the International Tax Group, based in Atlanta, but work out of St. Louis.
All right. And I'm Brooks. I'm sitting here in Richmond, Virginia today. So, Sarah McGregor, how's life treating you?
Life is good. I'm glad we're talking about international issues in this week when the Olympics has just gotten started. And it keeps me up late at night watching these wonderful athletes accomplish great things.
And there have been a lot of surprises in the Olympics so far. And I don't know about you, but I like watching the alternate channels where you get to see some of the sports that you don't always get to see. I enjoy seeing some of the fast-paced women's field hockey on those fast surfaces and the 3-on-3 basketball. And so anyway.
And I think I would drown if I had to play water polo.
You got that right. We'll talk about some serious stamina. All right, well, let's move to away from international sports and move into the more exciting topic of international tax. All right. So in general, we're going to talk about the proposed changes to the tax law that came in through the American Jobs Plan and then further explained by the Treasury's Green Book. I'll kind of run down those in a little more detail in a second. Next, we'll kind of look at where we are in the passage of any kind of tax bill in Congress right now, and then just briefly G7 and G20 agreement and those kind of discussions going on as well. So let me just back up and set the table in a little more detail. On March 31, the White House released the American Jobs Plan. I think they called it a fact sheet. And that was really the first formal introduction of their tax proposals that relate to the international provisions we'll be talking about today. Then 2 months later, approximately May 28th, the Treasury released what they call the general explanations of the administration's fiscal year revenue proposals or something along those lines, but everybody calls that the Green Book. So that's what we'll refer to it for the rest of this podcast. In that Green Book, there are numerous really important international tax proposals and can be deeply impactful. So I'll just run down the list. We have a lot of acronyms, and so we'll have to go back through them again when we get into the deeper discussion. The first was going for a global minimum tax of 21%. The proposal to get to that global minimum tax of 21% involved modifications to how you tax GILTI, what is called GILTI, Global Intangible Low Tax Income, I believe is the correct full name of it. But anyway, several technical modifications in that to get to a 21% overall rate, minimum rate, and that was, of course, in conjunction with a proposed U.S. federal tax change to corporate rate to 28%. So those two go hand in hand. But there were, regardless of what the federal rate is, there would be significant changes to the GILTI in and of itself, as proposed, I should say. Number two was to limit the ability to expatriate income. Many nuances there. Third was to repeal what's called FDII deduction, foreign derived intangible income. Fourth was to replace BEAT, base erosion anti-abuse tax, with SHIELD, stopping harmful inversions and end low tax developments. And then we have a hodgepodge of some other things, foreign tax credit modifications, 163J interest expense modifications, and eliminating the deduction for shipping jobs overseas. And there were a few more, but I think those are the highlights. I think it's to give some understanding of what the Biden administration is going for. The two themes keep coming over and over throughout everything. Avoiding the race to the bottom, that's a term and phrase that you hear over and over. And the other one was, just big picture, avoiding incentives to move operations, profits, property, jobs offshore. So I would say that, you'll see language throughout all their literature along those two lines. So let's follow that through. As of today, we're still in negotiations at the congressional level on how these proposals that are accompanied by lots of other tax proposals, lots of other spending proposals, how are those going to get through? We have a tentative, or at least a proclaimed kind of compromise for 600 to 800 billion-ish of spending, but it seems at this point there's no tax provisions to go along with that. So it remains to be seen how that will be pulled out. And that's supposed to be kind of the bipartisan side of it. And then lining up is the 3.5 trillion expenditure package that will presumably be all Democratic, going through on a reconciliation, so they don't need the 60% in the Senate to get it through. So where all that goes, who knows at this time? That seems to be changing every day. And then off to the side in the big picture of the international governments, we have G7, G20 meeting, and the hot discussion is, can we get to an agreed upon global minimum tax rate of 15%? And that seems to be the number that everybody wants to talk about. And while it sounds fine for some of the larger countries, we certainly have some of the smaller countries in the G20 not happy about it, and we certainly have some other tax havens in other countries throughout the world, who would probably not be very happy with that at all. So I think that's the laying the table. So I'm going to turn it over and start with Brian and say, so give us your professional opinion about, what does all this mean as far as global tax, in your opinion?
In my opinion, well,
Yes.
I think I think you said it really well, Brooks. For the last 40 years, the Democratic administration uses the term race to the bottom, but there has been competition out there to attract jobs, to attract facilities, to attract research and development across the globe. And certainly tax has been part of that. And for the most part of those 40 years, most jurisdictions have migrated to what is known as a territorial taxation system, meaning they only tax the profits associated with earnings in that particular country, and that profits earned offshore in other jurisdictions were not subject to tax. And that has not been the case in the United States. And corporate America, businesses, private equity have argued that it put them at a competitive disadvantage. And we saw the first signs of not just admitting that, but trying to be competitive on a global landscape with the 2017 Tax Act. Yes, you had GILTI, but you also had the first signs of a territorial system. And that's where we moved. Well, the political winds did not move far enough, and it quickly changed. And here we are again with not only wanting to move to a minimum tax on global earnings for U.S. companies, and we can talk about that with the GILTI provisions, but also wanting to lead the world in requiring a global minimum tax. And we'll talk a little bit about how they're going to do that via SHIELD. But certainly you're right. I think the G7 nations are all about this. But those countries that don't have huge economies, let's take Ireland at 12.5% rate, they have been politically savvy and said, we'll look at it. I think those type of countries, though, they're very tied to trying to be competitive, not just in their corporate base, but also what they can attract to their country so they can develop. So I think actually being able to implement this on a global basis is a huge undertaking.
And I think I mentioned this on a prior podcast, it's not without impact when you do something like this to some of those countries. I mean, it will mean loss of business and jobs at some point. I mean, does that get you, the end game get you a net zero effect if everything balances out? I'm not so sure it does with, some of those smaller countries, for sure. Yeah.
Well, Brooks, unfortunately, I'm old and I've been around a long time. And in the 90s, Treasury was all about a concept called capital export neutrality. And they did take a policy interest to an extent at making sure, that the United States was not adversely harming other countries and allowing developing jurisdictions to develop. It does not look like that policy is the same. I mean, there hasn't been a formal retrenchment of that policy, but at the same time, it looks like it's not a priority anymore, and that to encourage development in developing economies does not seem to be as much of a priority.
That certainly has not been included in any of the messaging so far. I think that's safe to say.
So, Michael, let's bring you in here to talk about some of these proposals that Brooks outlined from the American Jobs Plan and the Green Book. First, I think the one that's clearly catching the most attention is this the repeal of FDII, the FDII, and also the changes proposed to GILTI tax. Give us your thoughts on that.
Sure, Sarah. The FDII was put in place as part of the Jobs and Tax Act to really do two things. One was to encourage, at least the stated goals were to encourage investment in the United States and help bring jobs to the United States. Now, it was written broadly, but it did, I think, have some of those intended impacts. But it did provide for a very low rate of tax on that income. And so there have been complaints not only by the Biden administration, but our people in the OECD who have said this is an illegal export subsidy, and therefore it really shouldn't be allowed. So I think taking those concerns into account, the Biden administration feels that this really hasn't achieved the goal of creating jobs and being worried about the OECD, decided to repeal the FDII regime, which will take away an export incentive for some industries. Now they may replace it, as we're going to talk about, I think, a little later, about other incentives they may do create jobs in the U.S. But this will take away pretty much the last tax incentive on the books to create export subsidies. I mean, there still will be what they call an IC disc available for some taxpayers to use. So there still will be one out there, and so I think we'll see people start to think about that again. But it really will be a shift from where we were just 4 years ago. Getting rid of FDII. As it relates to the GILTI, the GILTI regime is still going to kind of stay around, but it's going to be modified. Part of the calculation is, there's a 50% sort of haircut when you do this. They're going to reduce that down to 25, to really drive up the tax rate on that, GILTI income, as Brooks talked about. That'll get that up to that 21% range, which is where the administration feels comfortable with doing that. They're going to, they think GILTI is currently structured with this, 10% haircut for qualified business assets. They're going to take that away because they think that encourages people to invest in tangible assets offshore, even though there's really no evidence that is taking place. So they're going to take away that, so that, again, driving up, the potential amount of income that could be subject to GILTI inclusion. You know, as Brian said, you know, that IRS government made, you know, shifts towards sort of a territorial back when they enacted all this, but, you know, the GILTI kind of undercuts the whole concept of territoriality. And, you know, by making these changes, you know, it's even going to make it less of a territorial system, I think, you know, by making these changes. And then there are some other small changes in the GILTI. You know, they're going to do, you know, instead of looking at this kind of a group basis, they're going to do it on a country by country basis. You know, it's unclear exactly what they might do with foreign tax credits, because right now there is a haircut. They may leave that in place, which if they do, would also drive up the effective rate on those GILTI earnings. So, you know, it's going to be very interesting to see. People are, you know, pushing back against, you know, the changes. I mean, certainly U.S. manufacturers would like to keep the FDII deduction. They think it does help them be competitive when dealing with low-cost jurisdictions that produce goods and ship them into the U.S. But, you know, I think if reconciliation does take up tax, I think FDII probably will disappear. The GILTI, you know, will stay, and we'll see what changes are made, because there has been more pushback, it seems, by some of the moderate Democrats not to make as many radical changes to the GILTI regime.
Great. And then some of the other proposals out there also impacting how companies will actually account for their total income. But Brian, this anti-inversion seems to not be getting a lot of attention, but could be hitting a lot of taxpayers unexpectedly.
Yeah, Sarah, I think, you know, just taking a shift back just a second, and I'll come to the anti-inversion of the SHIELD rules, because I think it all ties in. I think if you've heard a message across business and the business networks and corporate America, you've seen this general statement of they're not adverse to a higher tax rate. You know, that there's been some acceptance that, okay, we can go up in corporate tax rates. But I think where corporate America and businesses in America are highly concerned, and I think Mike alluded to that, is the idea of the foreign earnings and the GILTI regime. And I think the early tax modeling that companies are doing around GILTI and the changes put the U.S. at a competitive disadvantage on a global basis. And I think there's a lot of concern around that. And that goes right into SHIELD. No, it's not a Marvel comic concept, even though tax attorneys seem they want to be part of Hollywood all the time. But it really means, as Brooks said, stopping harmful inversions and ending low tax developments. And how they're going to do that, or at least, you know, we don't have a lot of details, of course. I mean, they're conceptual. But the idea is, and let's take Ireland again, the idea is if you make a payment, U.S. company, to Ireland, and you would not get a deduction if the counterparty is not paying a sufficient amount of income tax in Ireland. And so let's say that tax rate is 15%, but Ireland only is imposing 12.5%. That would be a non-deductible item for your company here in the U.S. And so that's the low tax developments. And already, I think Mike and I, you know, as everybody knows, the transaction and M&A world is very hot right now, and there's just a lot of transactions going on. And people are surprised when they bring in foreign investors, they set up new structures, that they're already running into the anti-inversion rules and don't even realize it under existing legislation under 7874. These new rules make it even tighter. And so I think one of the unintended consequences of SHIELD could be that a lot of our client base, the dynamic middle market, could end up inside these rules and not even realize it, because there was no intent, you know, to have an inversion. Let's say you set up a U.S. company as a SPAC, and it ends up being a foreign company. There, you know, are you running afoul of these new rules or the existing rules? I think there's a lot of unintended consequences here that could put a drain on U.S. business.
All right. I would the 15% global minimum tax is really, really seems to be the showstopper and grabbing all the headlines. And so we've moved, as we talk about the Green Book, 21% to this 15%. Mike, let's hear kind of your take on it. I mean, what should U.S. companies be thinking about and concerned about with this 15% global minimum tax proposal?
Well, I think U.S. companies, as they look to, do activities offshore, or if they set up operations offshore, I mean, I think they need to be sensitive to that there is a proposal that, they're going to have to pay a 15% minimum tax, possibly. I mean, people think of Ireland, as we've been talking about, at 12.5%. People like 12.5%. But now all of a sudden it's like, if I want to go to Ireland, I may be in a situation where I will be at 15% if Ireland is kind of forced to go along with this. Some of the other low tax jurisdictions, Hungary's always one talked about, they've, raised their hand, say, hey, slow down, because, we need jobs and we can't get jobs at 15%. So, that's one aspect of it. The other aspect ties back to the shield, if a company is subject to shield. And right now, as proposed, shield has a fairly high threshold as to what company it's targeting. But, when revenue raisers become part of the issue, some of those thresholds can certainly drop down to a lower number. And so we'll see what happens there. But, shield has baked into it this concept of, right now a 21% minimum tax. And, people are concerned if there's this 15% that's how somehow shield needs to adjust to come down to 15, because otherwise you force everyone else to come up to 15, but you in the US are saying 21's the number. And so the rest of the world may have got up to 15, but you're still saying 21 should be the number. And so now shield's going to apply to those things. So that's, the 15 really triggers potentially a lot of things in these proposals, and not just, for the US, but, even for globally. One thing I just want to point out on shield, if you are subject to it, something that's different than the BEAT, is it is also targeting cost of goods sold. So that, in a shield context, you may buy a product from a related party in a lower tax jurisdiction, like in Ireland, which does a lot of manufacturing, or a special tax regime somewhere else around the globe. And you could lose a deduction because your cost of goods sold is reflecting that low taxed payment. So, some would probably argue it's going to raise the cost of purchasing goods, which, I'm not an economist, but, add to just the increasing cost we're seeing, because now companies are going to have to pass that cost on to other people. So it really is a change that the U.S. is, forcing, or at least suggesting, that people ought to have a minimum tax, on a global, as Brian said.
Right. So, and it only seems logical that some of that will be passed on, because that's what we normally see anytime we ever see other rates in any kind of jurisdiction. But let's kind of go down to a slightly more granular or practical level. Let's talk about allocation of income amongst countries and how that could become even more important. And can you talk a little bit, Mike, about transfer pricing and Pillar 1, Pillar 2, some of those concepts?
Happy to, Brooks. I mean, the OECD has been working on, concepts to create a fair tax system, for many years. And, we've had country by country reporting. They've talked about transfer pricing over the years. This Pillar 1, Pillar 2 that's now been out there, and that G7's been talking about, G20's talking about, even the OECD's, now said, we've kind of reached agreement, is, Pillar 1 is an effort to allocate profit to jurisdictions and to take some of the, guesswork out of transfer pricing, to take some of the subjectivity out of transfer pricing. And by, creating, say, hey, we're going to come up with a framework, which basically, similar to, you might say, state taxation here in the United States, of how we allocate profit to various jurisdictions. And it really is going to do that. And, part of what has driven this is really the, development of the internet and commerce that's taking place over the internet, because, the big companies certainly have learned, hey, I'll put all my risk in Ireland, tax it at 12.5, but yet I'm selling product, in France or England where the rates, 20, 26%. And so that has driven it. There's been a lot of conversation about digital services taxes. So this is all tied up in this pillar one in allocation and profit, so that if the countries can reach an agreement as to how they allocate profit, then maybe some of these things like a digital services tax can be eliminated because you take some of the pressure off, everyone getting their fair share of the pie, so to speak. This all then ties into the pillar two, which is where this concept of the global 15% tax rate is, saying that, okay, we want countries to make sure that they have this tax rate of 15%. We don't want people competing for capital, jobs, based upon the race to the bottom, as we've talked about earlier in this conversation. And so, the two kind of go hand in hand, that we're going to say, let's make it easy to allocate profit to a jurisdiction, and then let's make sure it's paying that minimum tax under pillar two. Again, these are set up right now as if these will only apply to, companies that reach a certain revenue threshold. But again, like anything else, once you start down this path, I think you'll see countries say, hey, we're just going to do 15 if it's 15% across the board for everyone.
Sure.
We're not going to care about the size of the company. We're going to follow this allocation method regardless of what's there, and try to take out some of that, subjectivity, which unfortunately, the system needs, because not every business is the same. Every business has a different risk profile, a different economic profile, and transfer pricing is that mechanism that allows you to try to account for some of that.
Right. All right. So, any last comments on 15%, Brian? I mean, I think we've gone over a lot of this, but what's your final say here?
No, I think Mike captured it very well, that the idea of moving to 15%, I think the affiliated rules and how they're going to interpret those will be a big deal. I think really the 15% is applying on the foreign side, and then on the U.S. side, it's the mechanism is more GILTI to get people to that minimum tax, which Mike expertly said is really higher than 15% under the new proposals.
Yeah, and I'd like to just add one other comment. I mean, from a competitive standpoint, people are complaining. It's like, well, you're going to get the rest of the world at 15%, but you're going to be taxing us at 21%. So how is that keeping us competitive when we're going to be paying more tax than potentially everywhere else in the world if they all go to a 15% rate? So that is, I think, a discussion that'll be interesting to see as you force potentially other countries to say that they're going to tax you at 15% and nothing else, or at least rise to 15%, and you're going to be taxing your companies at 25%, 28%, 21%. It all depends on where this discussion on the U.S. corporate tax rate goes.
Yeah, but that's not new. I mean, we've had a higher corporate tax rate here in the U.S. on U.S. earnings or worldwide earnings, and dealt with countries with 0 or 4 or 12 rates. So this at least brings all the countries a little closer together in those rate differentials.
Yeah, no, absolutely. But it will, I think, put pressure on, and that's why you've seen the proposal on, changing how countries might invert, or companies might invert, because again, anytime you can find a lower rate, companies do consider about trying to get to that lower rate, and inversions have had their ebb and flows over the years as the rates have changed.
Mm-hmm. And we still have to get all of those countries who have agreed in principle to a minimum tax down to get their actual legislation and laws changed to a 15% rate, which could take some considerable time.
Yeah, I definitely agree with that statement.
Okay, let's move on to kind of a more of an economic side of this, to talk about supply chain, big picture. So Brian, what do you see happening with companies' global supply chain, potentially as a result of some of these tax proposals?
I think the hope is that jobs and manufacturing and those type of things would move back to the United States from a purely competitive perspective. But as Mike said, well, what about the rate differential? You're forcing the rest of the world to go to 15, so they will still be at a competitive advantage. What's going to happen? So if you do move back to the US, as we've seen as a result of COVID, that the supply chain disruptions, what's the regional supply chain going to look like? How are they going to break that out? What are the regional incentives? And when I mean regional, I mean, what does Mexico look like from an incentive purpose? What does Honduras look like? Those jurisdictions for maquiladoras, for outsourcing, those type of operations. I think that's going to be important for private equities and private companies in the supply chain. How are they going to use the IC disc continually for exports and export subsidies? And then, of course, on a global basis, what do those supply chains look like with the new global allocation rules, with new tax rates? And we haven't even gotten into or talked about, the compliance and your accounting systems that will need to be updated. If we go to a book income concept for a global minimum tax, how do you do your local tax books, but then run an effective rate calculation of 15% based upon financial statement earnings? It's just the complexity level. Once you get into the details, and compliance seems to me to be very complicated and could take Herculean efforts just from a compliance perspective.
Yeah, Mike, you were commenting on the increase in focus on transparency and the reporting that's coming along as well.
Yeah, I mean, just very quickly, I mean, the U.S. started this craze on transparency many years ago. Everyone thought they were just off the rocker, so to speak, and everyone else has jumped on board, all the foreign countries. So everyone's looking at knowing who your customers are, trying to find, making sure people are properly reporting their income. So withholding reporting has taken on renewed emphasis for U.S. companies. It's an easy place for the IRS to find money. And if we are trying to close the tax gap, this is certainly a starting point, and there are some proposals by Biden to require even more information reporting. So I think, foreign countries clearly have adopted it. The U.S. has had it for a while. So I think you will see a renewed emphasis on making sure, particularly here in the U.S., that U.S. companies have got the proper documentation in place, that you are doing the proper withholdings on that, because I think the IRS will, if they get their funding, will certainly hire people in those areas, because that's an easy area to train in and get people, moving quickly on.
That's great. Brian, you've mentioned a couple of times the IC disc, that interest charge, domestic international sales corporation. Why is that still a good choice for companies to consider today?
Well, I think it's a great choice for companies to consider today, as it gives an ability to essentially, especially for private companies, you exempt certain profits from corporate taxation or taxation at the operating level, and essentially only tax at the shareholder level those profits. So it's both a rate arbitrage and an exemption system. And it's the only thing in town with regard to a benefit for your export sales and activities if FDII is off the table. And that will be the only export regime that we really have from a corporate income tax perspective available to us going forward. The critical thing, though, is if FDII were to go away, you can only use an IC disc if you've set it up. So if you haven't set up your IC disc, if you haven't made the election, you can't run export sales through it and avail yourself of those benefits. So it's something to consider sooner rather than later, simply because until you set it up and make the elections, you don't get the benefit.
And speaking of sooner rather than later, what are your thoughts on what a company should do in light of these proposed changes of GILTI that are out there?
I think you should be conservative in thinking that your overall effective rate on your foreign side could be going up. And what does that mean? If you're in a corporate structure or have corporate blockers, should you be evaluating migrating back to a flow-through structure, meaning partnerships and flow-throughs and availing yourself of foreign tax credits? Those basic planning techniques that might be critical for your business to be competitive out there.
All right.
And I think it puts sorry, Brooks, let me just say one thing. I think it puts the premium on what Brian's saying of, really starting to think about modeling, looking at, what these potential changes can have, because, it really can make a difference, whether you can take a credit or not. So I think quantitative analysis will now become more important.
All right. Awesome. Thank you, Mike. All right. So I think it's time for us to wrap up with any final comments. Brian, you have anything else you like to add? Words of wisdom?
I think the words of wisdom is the political winds are higher taxes, and certainly the number one area people are looking, the big flash is the rates, but businesses are well aware that the international is really where the substance is for higher impact, for a larger impact for higher taxation. And I think Mike's exactly right. Quantitative analysis and modeling is going to be critical, because I think the impact on multinational businesses could be substantive if this were to go through.
Sarah, you got anything to add?
I just echo that the ability for companies to be flexible, even as large and as difficult as it is to move operations, move people, think differently about their organization. I think that thinking has to start now, because it does take time to implement those changes. And by the time these rules could be passed, you want to be in that process of moving to your optimal organizational structure and strategy.
And Mike, anything to add on?
I think the only other point kind of in line with these two is, what I'll call acceleration. I mean, if you're thinking of doing an acquisition, or if you're thinking of doing an inversion, or, I think you want to get it done as soon as you possibly can in anticipation of you now know what the rules are. Because if you get a deal going now and it doesn't close till next year and things have changed, your economics of that deal may no longer be in line with what you were anticipating.
All right. So I guess from my perspective, all that comes to my, what keeps coming to my mind, I should say, is planning, the tax planning. And this will turn, global tax structure planning upside down if this stuff, even half of this goes through. I think companies need to be planning now to, now that, we got a good idea where things are going. We don't know where it's going to end up, but certainly the process, much like Sarah was saying, start thinking about now what your options are going to be and be ready to move. Because I do think this would be game changing, and I do think it's substantive tax increase, and it is. I think it's, for many people, it's politically favorable to sit there and say we're going to go get the foreign income and tax that more. That plays well politically. So I think anyway, more to come. So we'll keep monitoring. All right, so thank you everybody for listening to our discussion today on the proposed changes to U.S. and global tax structuring for multinational companies. Quick disclaimer, we're not providing tax advice on this podcast. Please consult with your tax advisor, hopefully at Cherry Bekaert, with your specific tax issues, or to discuss information from today's podcast. Check out our firm's website at cbh.com for the latest guidance and materials on this and other tax and business topics. We've had a couple of podcasts already on the Green Book, and we had one on the American Jobs Plan earlier. So for background on some of the other, some of these concepts we talked about, you could go there. All right, this concludes today's podcast. Thank you, Brian, Mike, and Sarah. Thank you, our listeners, for spending your time with us. We truly appreciate it. Let's call it a day. Go forth in peace.